Can the Canara HSBC Promise4 growth plan offer complete control over your savings and insurance needs in the long term? Let us find out through an in-depth analysis in this video. Hi, welcome to holisticinvestment.in. We help individual investors like you to make the right financial and investment decision and to reach your financial goals in a more faster and smarter way. So before analyzing this policy, let us first understand what is this policy is about. So this is a unit-linked individual savings life insurance plan, and this product is a non-participating product. And some of the key features of the policy are: you get to enjoy life coverage for the entire policy term. You have the flexibility to choose between paying premiums throughout the policy tenure or for a limited period. You can select from 3 plan options like Promise for Wealth, Promise for Care, or Promise for Life, tailored to your life stage needs. Only fund management and risk charges apply, enhancing your savings potential. Mortality charges deducted during the policy term are added back to the fund value at maturity. You can access a selection of 9 investment funds. You can also optimize your returns with multiple portfolio management options aligning with your investment strategy. You can also enjoy potential tax benefits on premiums paid and benefits received, which is subjected to the prevailing tax laws under the Income Tax Act of 1961. Now, the benefits like death benefit, maturity benefit, and loyalty additions all differ according to the plan options, like because there are 3 plan options as I have already mentioned: Promise for Wealth, Promise for Care, and Promise for Life. So these benefits will differ based on the plan option you have opted for. So if you want to know more about it in detail, you can definitely refer to the policy brochure. And now let us take a look at the fund options available under this plan. There are 9 fund options, which are Large Cap Advantages Fund, Mid Cap Momentum Growth Index Fund, Emerging Leaders Equity Fund, India Multi-Cap Equity Fund, Equity 2 Fund, Growth Plus Fund, Balance Plus Fund, Debt Fund, and Liquid Fund. And all these fund options are allocated based on the percentage of allocation they have to asset classes like equity, debt securities, and money market, and also according to the risk profile each fund option has, which can range from low to medium to high. And they also have different strategies like investment strategies such as systematic transfer plan, return protector option, auto funds rebalancing, safety switch option. So out of these investment strategies, whichever you think is suitable for you, you can opt for those. So what are the charges under this policy? So there is no premium allocation and policy administration charge, but we do have fund management charge under this policy. So out of these fund management charges, whichever fund option you have chosen, and if it has a higher risk profile, your charges will be higher also. So based on the risk profile on the fund, the charges will vary. And it also has discontinuance and surrender charge, which will depend on the year you choose to discontinue and your premium amount and your premium paying term. Then they charge you for mortality charge for life cover, and there is something called premium funding benefit, PFP charges. This is only applicable for premium plus. So this charge will apply on the present value of your future premium, which will be payable by the policyholder for an in-force policy. And there is no other charges like partial withdrawal charge, switchers charge, miscellaneous charge. While this plan does not impose higher fees than other ULIPs, certain charges do continue throughout the policy term. So these ongoing costs can gradually diminish returns over time, impacting overall profitability for the investors. So now, as we have a basic understanding of how this plan works, let us take a look at the advantages and disadvantages of this policy. So the advantages are: the milestone withdrawal option provides liquidity at key financial milestones, and you get partial withdrawals which are allowed from the 6th policy year onwards, provided the life policyholder is at least 18 years old. The systematic withdrawal option also enables you to generate an additional income stream during the policy term. The settlement option is also available under the Promise for Wealth and Promise for Care plans. The premium redirection is available at no additional cost. You can also enjoy unlimited free switches between funds for greater investment flexibility. The freemium fund benefit is also applicable to the Promise4 Care option, which ensures that your savings contribution continue even in your absence. And you can also adjust your policy to meet evolving financial needs by modifying your premiums, payment terms, and policy duration. The disadvantages are this plan does not offer a loan facility and your funds remain inaccessible during the first 5 policy years, and the sum assured may also fall short of financial requirements, and investment returns that you get from this policy are lower compared to other alternative options available in the market. So these are the drawbacks that you need to be considered carefully before deciding to investing in this policy. So now, as we have a basic understanding of this policy, let us now move on to the analysis part of the video, where we are going to evaluate the performance of this policy and compare it with other investment options. But before that, we are going to conduct an internal rate of return IRR analysis based on the policy figures from the policy brochure. Now, just for calculation purpose, let us assume that a 21-year-old male opts for this policy with a sum assured of 12 lakhs. The policy term and premium paying term are both 15 years with an annual premium of 1.20 lakh. So he selects the Promise4 Wealth option. Under this option, the fund value is available at the end of the policy term, assuming he had paid consistently the premium payments. So the policy brochure provides the projected returns based on two assumed investment rate of return like 4% and 8%. These returns are not guaranteed and do not indicate the only upper or lower limits of potential returns you can get from this policy, because the final maturity benefit depends on multiple factors including the policy's market performance. This is just to give you an idea of worst case and best case scenarios. So at 4% return, which is the worst case scenario, the projected fund value is 22.54 lakhs, resulting in an IRR of 2.76%, which is lower than the interest offered by a savings account. 8% return, which is the best case scenario, the projected fund value reaches 30.80 lakhs with an IRR of 6.46%, which is comparable to or potentially lower than a bank fixed deposit rate. So although this policy is a market-linked product, the returns do not adequately compensate for the associated risk. So while designed for long-term wealth creation and inflation protection, its returns fall short, limiting wealth accumulation. Consequently, the corpus generated through the policy may not be sufficient to achieve your financial goals. Now that we know that this policy is not giving us the desirable outcome that we need, because it faces limitations in terms of suitability due to its inability to generate inflation beating returns and an inadequate sum assured. That's why we are going to compare this policy with other alternative strategy, where we are going to invest in insurance and investments separately. So just to see whether it can give us better returns and better liquidity, conducting a comparative analysis. So in this alternative strategy, let us consider for example purpose that you purchase a pure term life insurance policy for life insurance purpose with a sum assured of 12 lakhs at an annual premium of 4,400 rupees. With a policy term and premium payment period of 15 years, this leaves us with 1,15,600 rupees available for investment, which can be allocated based on individual risk preference. So if you are a low risk investor, you can opt for debt instrument like the Public Provident Fund (PPF), which is a government backed fund giving you stable and safe returns, and it's a low risk debt fund. So over 15 years, the PPF investment accumulates to 31.35 lakhs, yielding an IRR of 6.67%. This return is comparable to the 8% scenario of the Canara policy, despite PPF being a low risk debt instrument. So if you are a high risk investor, you may choose equity based options such as equity linked savings scheme ELSS fund, which also is a tax saving tool. And in ELSS funds, you can see it has historically outperformed even its average 12% return if you choose to invest in it for long term, like over 10 years. So the pre-tax maturity value in ELSS reaches 48.26 lakhs. So after accounting for the capital gains tax, the final maturity value is 44.55 lakhs, delivering a post-tax IRR of 10.68%. As a market-linked investment, the ELSS offers superior risk-adjusted returns along with with the flexibility to withdraw funds without restriction. In contrast, the Canara policy falls short in terms of liquidity and fails to deliver competitive risk-adjusted return, making the alternative strategy a more effective approach to financial planning. So, what is the final verdict? Is investing in the Canara HSBC Promise for Growth plan worth it or not? So, this is marketed as a customizable solution because it offers three variations like wealth accumulation, a plan with a waiver of premium option, and whole life coverage. At first glance, its features suggest it can help investors achieve financial goals and secure their family's financial future. However, a closer analysis reveals that the plan falls short due to its weak return potential, and it also has a high agent commission. The charges and lack of transparency in investment management significantly impact the plan's performance, resulting in subpar returns and limiting wealth accumulation. Additionally, the low sum assured makes it less attractive. So, the combination of insurance and investment within a single product further reduces the Canara policy's overall efficiency. So, a more effective strategy is to separate insurance and investment because a pure term life insurance policy provides adequate coverage to protect your family financially, while investing separately allows you to align with your financial goals based on your time horizon and risk tolerance. So, before investing, always assess the potential returns of a product to ensure it meets your financial needs. If you want to read more about this policy, then you can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.